I mean, when we look at valuations, we don't see a global synchronized valuation cycle as we've seen basically post 2020-21, which was a really worrying picture because I think as a longer-term investor, what really matters is asset pricing because it's a good indication of where your forward returns will end up in the future. So when we look at the US market, you could easily say, well, look at the S&P 500, those valuations have gone up again and are rather stretched, but I think you have to broaden the picture here. And I think there is this strong AI narrative which is attributed to some of the largest companies and has driven up valuations there. But if you look even at the S&P 500 on an equal weighted basis, or you go to the smaller cap segments such as the Russell 2000 or the mid cap indices, I think their valuations are very muted, have actually come down and trade at levels which are comparable to like 5 years ago.
Markets can't necessarily accept monetary policy being another shock absorber as it possibly has in the future, because it seems like we're a long way away from cuts in interest rates, particularly. Where does the market pretty much look now for that shock absorber, if there's any?
Well, I think if you talk monetary policy, I think it's actually a very interesting topic because I think policymakers are still very reluctant to sort of agree that there has been progress on the inflation front. I mean, inflation rates have come down over the last 12 months. But it's understandable that they do so, I think, because you want to assure that you show credibility, that you're a credible institution. So I think you don't want to wait for them to pivot, actually. What you want to do is you position yourself at the moment for the market to build expectations that short rates will come down at some point in the future. And we think that there is actually a good case to be made for that, because when you look at forward-looking drivers of inflation, which were sort of the root cause for the inflation cycle we have globally and especially in the United States, they're all weakening. So first, monetary policy, I mean, is M2, monetary aggregates in the United States are shrinking at a record pace. In Europe, they have come to a stall, basically, also in their own time series at a very low point. So that alone indicates that we'll potentially see a lower inflation backdrop going forward. But then the other very important piece in the puzzle was fiscal stimulus. And fiscal stimulus went through a tremendous savings cycle. So you have the build-up of the savings and then the rundown. And that rundown of excess savings really has come to an end in our view, and there will be no more excess demand from that side. So demand will normalize fairly quickly from here in the United States, to a lesser degree in Europe, but I think that's going to normalize the inflation picture strongly going forward.
We've been playing a lot of tape from Sintra today, and Philip Lane has been giving the message that we are staying higher for longer, that we're not going to be seeing a pivot from at least the ECB at this stage. What does that mean in terms of equity market valuations if the heat is still going to remain fairly high on businesses and consumers for some time to come on monetary policy? Yeah,
so I think first, let's turn to the yield curve. What has happened to the German yield curve or the US yield curve this year, when you compare it to really the beginning of the year, you had the short end 6 month going up, and then you had actually from 5 years it was flat, and then 10 years actually were lower. So longer rates are actually lower than beginning of the year, despite the fact that the monetary policy has been stayed fairly restrictive, and even on the guidance from the policymakers being even more restrictive, right, and staying higher for longer narrative. But I think the market has already anticipated or baked in that there will be cuts going forward. And when we look just at the empirical evidence, if you look at the strongly inverted front end of the yield curve, so in the US 6 month yields trade a big amount above 2-year yields, that's often an indication that we're at the end of a rate hike cycle, that it comes to an end, and that over the next 12 months we actually see cuts in the interest rate. And I think that's the important piece. You want to position yourself as an investor before actually everything gets communicated, right?